In this video, we're going to look at some popular technical indicators used in quantitative trading. Technical indicators are used in quantitative trading to indicate emerging trends in prices or to indicate whether prices have reached extreme high or low levels. One of the basic popular technical indicators are simple moving average prices, and they're simply defined as the average of prices over some time period in the past. And on the right we have a interactive plot of the SPY ETF prices and the simple moving average SMA. So we can see that the blue line are the SPY prices, the red line is the SMA, and the shape of the SMA curve depends on the length of the look-back window, the time window. So it's set here to 21 days. If we increase it, the moving average becomes smoother, but it also increases its time delay or time lag. So you can see that the red line reaches its minimum much later than the blue line. So there's this lag also referred to as a bias. But the advantage of a longer window is that the moving average is a very smooth curve. So it's easy to see the trend in the prices, upward trend or downward trend. So in order to remove some of the bias and lag, we can decrease the length of the look-back window. And we can see now that the moving average follows much closer to the SPY, but it also wiggles a lot more. So we can see that it may actually drop down and create some kind of false positives. Another example of a moving average is the exponential moving average, EMA. And it's defined as the weighted sum of past prices. And the past prices are weighted by the powers of the decay factor lambda. So instead of a look-back window, we have a decay factor lambda. And we don't use just a fixed amount of prices from the past. We use all the prices in the past to calculate the EMA. And the EMA can also be calculated using a simple recursive formula, where the current EMA is equal to the past EMA times lambda plus 1 minus lambda times today's price. So when we look at the right panel with the SPY prices in EMA, we can see that the EMA looks very similar to the SMA, and the difference is that the EMA is controlled by the lambda parameter. If we make the lambda parameter closer to 1, the EMA price is very smooth and has a lag. This is equivalent to a long look-back window. And if we make the lambda parameter very small, the EMA price follows the underlying price much more closely, but it wiggles more. One of the other advantages of the EMA is that the weights are not all the same. So they decrease over time as so the prices from the distant past have very small weights compared to the more recent prices, which is a more natural feature. Now, the moving averages can be used in other technical indicators, in particular the moving average convergence divergence indicator, the MACD. And the MACD is used to determine trends in prices. And the MACD series is defined as the difference between two moving averages, the fast moving average minus the slow moving average. And on the right panel, I plotted the underlying SPY prices. Let's zoom in. So the SPY prices are a candlestick, are represented by these candlesticks, open, high, low, close prices. And there are two moving averages now. The red one, which is the fast EMA, and the purple, which is the slow EMA. And we can see that the slow EMA is much smoother. And when the fast EMA, when the difference between the fast and the slow EMA is positive, then that indicates that the prices are increasing. And when it's the MACD series is negative, that indicates that the prices are decreasing. We can see that even though the prices, SPY prices, bottomed out on March 23rd, there's a lag in the MACD series. The red line, the fast EMA, is still below. It's still catching up. It's still below the slow EMA up until about May. So there's a significant lag. We can correct that by reducing the lambda fast and also reducing the lambda slow. So now if we zoom in, we can see that the MACD series catches up, changes sign much faster. It catches sign, changes sign around April now. But the downside is that it also wiggles quite a bit. It changes sign back and forth, creating false positive signals. So to overcome that, there's a third moving average in the MACD indicator, and that is the lambda, the moving average of the MACD series is equal to the MACD signal. So the MACD signal is equal to the moving average of the MACD series. So the third lambda parameter controls this moving average. And then there's, to improve the signal, we take the difference between the MACD series, MACD, minus the MACD signal. So here on the right panel, I've illustrated what happens. The red line is the MACD series, which is the difference of two moving averages. And then the MACD signals, the MACD signal is the purple, the darker line. And the difference between the two, the MACD divergence, are the blue bars. So we can see now that the blue bars change sign when prices start rising. Pretty much very close to where the prices start rising. So the prices bottom out maybe in mid-March, and by the beginning of April, the MACD divergence is already switching sign to indicate the prices started rising. There is, though, a lag just as before. Okay, because the prices actually bottomed out on March 20th. And the MACD divergence didn't switch sign until April 3rd. So about 2 weeks lag. We can reduce that lag by decreasing the lambda. So if we decrease the lambda and zoom in, we can see now that this sign of the MACD divergence changes on March 30th, not in April. So by controlling these three lambda parameters, we can create a MACD divergence that closely follows the direction of the prices. But the downside is that if we do that, we can see that in other times, in other time periods, we can see that the divergence series switches signs back and forth and sending false signals. So even though there's no particular trend, strong trend in prices, then the MACD indicator tends not to produce reliable signals. Another indicator is the price z-score, and it's defined as the current price, P of T, minus the moving average price, the EMA price, divided by the volatility of returns, sigma. And the volatility of returns can be calculated using an EMA recursive formula, as indicated here. So let's take a look at the price z-score more closely. It uses one lambda parameter for the EMA. And again, we're looking at the blue line, which are SPY prices in 2020. And the red line are the z-scores, the price z-scores. And the price z-scores have a separate axis on the right. On the left axis are the SPY prices. These are the log SPY prices, to be exact. So if we zoom in the plot, we can see that the z-score tends to oscillate between negative and positive values. And it has negative values when the price drops locally. So when the prices are dropping, the price z-score tends to be negative. And z-score has positive values when the prices have recovered, after the prices have recovered. So, and that's why the price z-score is often used as a rich and cheap indicator of prices. Rich prices meaning they're overpriced, prices are high, and cheap prices are low. And we can control the value of the z-score by changing the lambda parameter. If we increase the z-score closer to 1, we can see that if we increase the lambda parameter closer to 1, we can see that the z-score is less volatile, and it also has a much larger range in values. So we can see that the z-score here reached, when the prices dropped to their minimum, the z-score was reached -5, and when they recovered, the z-score reached over 10. If we decrease the lambda, the z-score becomes very volatile, and it then oscillates a lot more, and it captures prices that have reached some kind of local maximum, if you will. So before, the prices stayed around 0, the z-score stayed around 0, even if the prices were recovering or dropping. The z-score didn't react as quickly. When the lambda is smaller, the z-score oscillates a lot more, but on a smaller range if you look at the right-hand side. So the z-score can be actually used in a trading strategy in which the strategy sells the stock if the z-score reaches some threshold value, positive threshold value, and buys the stock if the z-score reaches some negative threshold value. So in other words, the price z-score is used for not indicating trends in prices, but when prices have become cheap or rich. Another cheap or rich and cheap indicator is the relative strength indicator, the RSI. And it's calculated by as a ratio of the average gain divided by the gain plus the loss. So the value of the RSI is between 100, when the gain is very large, it reaches close to 100, and when the gain is very, very small, it's closer to 0. And the gain is calculated as a moving average over the positive returns. So the gains are the moving average of positive returns, and the loss, EMA loss, is the EMA of the negative returns. And the positive and negative returns are calculated as non-negative values. So R plus is the max of the return and 0. So if the return is 0, R plus is also 0. And R minus is the max of minus R, minus the return R, and 0. So when the return is negative, R minus just becomes minus R. So it's never negative. R minus is never negative. And on the right panel we have a plot of the RSI on the right axis and the SPY on the left axis. And we have one lambda parameter that controls the RSI. So let's look at the performance of this RSI. What is it telling us? Well, the RSI reached close to 0 in February 27, 2020, when prices suddenly dropped as a result of the COVID news or COVID epidemic. They rebounded then slightly, reached above 60. The RSI reached above 60 at that point, after which the prices dropped again, started dropping again, and dropped below 20 on March 9th. If we change the lambda parameter, if we increase it closer to 1, the RSI is a lot less volatile. So let me increase it to 0.9. So now we can see that the RSI oscillates a lot less. But it may also miss some local maximum prices and minimum prices as the prices wiggle up and down. On the other hand, if we decrease the lambda, it becomes very volatile. The RSI becomes very volatile, and it's able to more closely follow the local maximum of prices and local minimum of prices. So again, the RSI can be used as an indicator in a trading strategy. So I've created a very simple example of that in the next slide. And the strategy has two parameters, the lambda parameter and a threshold parameter called theta. And if the RSI is less than theta, then the strategy buys one share of stock and holds that position. And if the RSI is greater than 1 minus theta, then it sells short one share of stock. So the strategy is always either long one share of stock or short one share of stock, depending on the recent RSI value. So we have here a plot of the strategy, the P&Ls of the strategy, the RSI strategy in red, and on the left axis we have the SPY, log SPY prices. And I've calculated also the annualized Sharpe ratios for SPY and the strategy. So SPY has an annualized Sharpe ratio of 0.6, which is kind of typical over a very long time period, whereas the strategy has a Sharpe ratio of 0.8, so much higher. And the reason for that is I adjusted both the lambda and the threshold to optimize the performance. Unfortunately, the performance is very good up until about October 2017, but after that, the performance of the strategy did not perform well. So you can see it performed from 2017 into early 2020. It actually lost money, and after that, it started recovering. So to correct that, we could try to adjust the lambda parameter, and as we adjust it, we can see that the performance may improve in certain time periods and become worse in other time periods. So it seems smaller lambdas work better. And I can also adjust the threshold value. And as I increase the threshold value, I can see that it works very well for up until about 2012. The strategy worked remarkably well for very small lambda and for a threshold of 35, but not afterwards. It really didn't hardly performed at all. So this is an example of using a simulation with historical data to find the best values of the parameters of the strategy. It carries the risk of so-called overfitting of the parameters, so that the performance may be good in sample, as illustrated here in the right panel, but the performance of the strategy is usually not very good out of sample. So that's it in terms of the illustrating popular technical indicators in quantitative strategies.